Welcome back. We are now about to begin our Trader Talk segment with Sean Udell, Tech Trader. Good morning, Sean. How are you?
How you doing?
I'm doing quite well. I wanted to talk to you a little bit about where you are on these sentiment indicators that you look at, because we hit some what you called fairly extreme levels, or at least levels that were indicating that the buying may be starting. But we moved up pretty quickly over the last week. Did you get any extreme levels on the upside?
No, I mean they've kind of done what you could kind of expect. I mean they really did give a pretty good signal. I mean they gave a pretty good kind of a mini. Again, wasn't a December type signal, because that was literally a 1 in 5, 7 year type low. But we get these lows anywhere from 3 to 4 times a year. It kind of depends how many 5 to 10% corrections we get, honestly. But yeah, we got a pretty typical low. But yeah, I would say they're basically kind of back to neutral territory. And here's why: is the clouds don't. There's not enough cloud names that get like yesterday. It's easy to say in hindsight, but I mean, it's pretty clear that yesterday was some sort of a blow-off type top move. Now, whether it's an ultimate top, or whatever, who knows? But, you get beyond 186. I think I was saying in public Twitter, 185 plus was, hey, nothing to see here. Stock's going to 300, kind of jokingly, whatever. But you get that, you got every single cloud name actually went up. One thing we should talk about is the rest of the cloud group, the expensive cloud stocks relative to the Tableau deal. But you got, the cloud stocks going up on basically a data deal, which again, CRM's not paying 30 times sales for data. They're paying about, 11 times or something like that. So the bottom line, the stuff kind of just got rinsed higher. Sentiment numbers got rinsed higher, but again, it's not like a lot of the market has gone up. It's been a very small number of names again. Things that did heal up is like the percent of stocks in the Nasdaq. I think that hit 25%. Only about 22 to 25% were we're above the 50-day. That bounced about 10-15%. So those kind of things kind of healed up. But I mean, I would think we'd probably have to put in CPC put call ratio numbers are actually still pretty high. But yeah, we're not. We'd actually have. Here's what we'd have to have a sentiment top. We'd actually have to see more stocks go up. So you can't. If it's just the same sort of overvalued 8 to 15 cloud names, which is kind of replace the FANG names. It's kind of hard to get a major sentiment top. We actually need to see a rally with where we get broad participation to have sort of a major sentiment top. Either that, or you'd have to get these cloud names to, truly nutty type levels. But yeah, they've just sort of healed up. In fact, we've almost gone. In fact, I'm looking at a couple numbers. We've almost gone from kind of that real low kind of crystallizing sentiment bounce reading to kind of just a higher low reading. I mean, sentiment's still actually pretty low. And it kind of makes sense. I mean, if you just kind of think about what's moving, what's worked, what hasn't worked, what's getting beat. I mean, small and mid cap stocks haven't done anything. Value stocks haven't done anything. Oil patch, retail, commodity names, all that stuff is still pretty beaten up. So, it's kind of hard to get, to make a lot of new highs when most stocks are not at new highs. It's kind of hard to have, various levels on the NYSE, which is kind of more representative of the average stock, really spike. So yeah, I would just basically say it's kind of been a sentiment heal up from kind of a low level is probably the best way to say it.
All right, so why don't we talk a little more about the data deal, the CRM for data, and how it relates to some of the other ones, and what does that imply? Because yesterday a lot of the cloud stocks went up in sympathy.
Well, exactly, and I mean, I posted that. Look, data CRM's not paying 30 times for data, and nor should they, but they basically paid pretty much what they pay for most deals. I mean, I think they paid a little more for Mule, but if you remember, one of the reasons I was disappointed in the Mule buyout again, it was a double, but I mean, Mule today, I don't even know what Mule would be traded at if it was still a publicly traded company, because it would likely be trading in line with Vive and Coop and a lot of my other former longs, Okta, etc., Twilio, whatever. So there's pretty much all those names are like anywhere from 24 to 30 times sales. And Mule likely would sort of be there. And again, I'm trying to remember what I know they paid about 11 to 12 times out year. I think that translates to about 14 times current or trailing. Again, that would be dirt cheap, and for their growth, that would be dirt cheap today. So, but yeah, no, CRM basically does what they always do. They probably did a little bit of an overpay. But they bought it. In this case, they're buying quite a bit of revenues. They're buying quite a few customers. I don't know, some of those they may have already. But, they're buying an area that they don't really have a platform in. So they're buying their way into the database market. The thing that I kind of wondered about was, had they maybe been talking to Splunk, and I don't Splunk. Splunk would be hard to buy. Because I think I don't think they would want to be bought. So that'd be you'd have to go full hostile. I think data was far more agreeable to a buyout. And by the way, relative to growth, I mean, data's halcyon growth days have long passed. I mean, you're talking a mid-teens grower. So even though data didn't pay an exorbitant price relative to the most expensive clouds, relative to growth, I mean, they definitely paid up for data. But anyway, so to round this off, I mean, I don't think CRM paying 10, 11 times for Tableau is in any way a ringing endorsement for people to pay 35 times these other stocks. And I don't know if it's a coincidence. I kind of think it's a cause. I mean, I think the fact that you're seeing Zoom down 8. Zscaler's down 3. It's really not that much, but you're seeing pretty good drops in a lot of the cloud names today, and they'd already dropped pretty hard from their highs yesterday. So we'll see what happens. But I think that again, I think if one looks at this and doesn't just use hype and momentum, but actually uses some analysis and says, look, what does the analysis say? Is CRM basically saying we should be paying 30 times for companies? I would probably say not, because they basically sticking to their knitting. They're paying relative valuations that roughly similar to what they've done in the past when valuations in software were much cheaper. So I would say it's basically sort of an anti-call. Hey, if we CRM come in and buy stock and pay 30 times, okay, well, then we see that. But until we see that, I haven't seen any M&A at the prices that these stocks are selling for right now.
All right, Sean, I'm not sure if your microphone is a little further away today, but some of the listeners are saying that they're having trouble hearing you, so I'm not sure if maybe there's a quick adjustment you might be able to make.
I'm on Bluetooth. Looks like it's pretty clear. I mean, can you hear me okay? I don't know.
Yeah, it's a little faint, but it could be something on my end. But I'll try to adjust this anyway. All right.
Yeah,
so
sounds the same. Sounds the same to me. But just to wrap it up, I mean, we'll see. When we're in a market, and we're kind of been in the same market. FANG. We had FANG before, and then we had the hype of the pod stocks, the hype of the AI, the small little AI stocks. I mean, I think there was some weird AI stock that went from 3 to 70 and back to 5 or something. We had the hype of crypto. The crypto stocks like Elfin and stuff like that. So Beyond's more of a real company, but it's sort of the same. I mean, a lot of people are comparing Beyond to Tilray. So in a market like that, you're going to have a lot of stuff get very mispriced, and I mean, I think we're seeing that. The question is, okay, what causes a big unwind? Do we ever have a big rotational trade again? We've had a few. I mean, we're kind of due for one. But yeah, so we'll see what happens. I mean, that would be nice to see. Actually, it's actually a sentiment kind of your first question, sentiment rising because the market is broadening out, as opposed to sentiment rising because a small number of stocks are getting ever more extreme. So we'll just have to see how that plays out. But I really do think that, again, CRM, probably a good deal for them, great deal for data. And we'll see over time what happens. But again, you said it. Most of the space was bid up, especially at the open, pretty aggressively. The highs didn't hold. So, and today you're getting a further rollover. So we'll just kind of have to see what happens. But like I say, I think the major point, the key point is, I would say CRM's buy of data is definitely not a ringing endorsement of paying 30 times or 35 times or even maybe up to 40 times for various cloud names.
As it relates to CRM, do you think it's a good deal for this company? And is it now I would suspect that you think CRM is a little too frothy for you, but at what point do you find CRM attractive?
I probably last liked them or thought about buying them. By the way, that was a name, did very well from that name kind of when I early on in the platform when I came over to briefing. I'm just trying to think where that was. I'm just trying to think the last price I really liked them. And I think it was around 65. And 3 years ago, it might have been early 17. I'm trying to remember exactly. But, I think at the time, that was when I liked, names like Workday and Splunk and CyberArk. And so, I did like them. I've been long the name a few times. I don't need, December, they bounce pretty good from December. Sometimes you don't need to, CRM is it's a lot like Workday. It's never going to be cheap, right? Maybe put it this way, by the time it's actually cheap, you probably don't want to own it because they're not growing anymore. And maybe they're getting outmoded by more innovative companies that are CRMing CRM. Like, I don't know, is that 5, 10, 15 years from now? But again, my view would be you probably don't want to be buying the stock if it actually gets cheap, because it'd probably be akin to buying like IBM or something. But so it's never going to be cheap. Workday's probably never going to be cheap. Splunk's never probably going to be cheap. So you have to kind of pick your spots. I would almost say you can kind of look technically. And yeah, I don't know, December, November, December lows. The other thing, we talked about this a lot late last year. Some stocks never retested the November low. This was one of the stocks that the December low was higher than the November low. So you kind of have a nice, pretty clean double bottom. If people got really kind of crazy and like really negative on this deal, and you saw 130 or something on this, it'd probably be a relatively safer name than other names. Although again, technology is always going to carry more risk. The more expensive stocks are always going to carry more risk and things like that. But I do think in general it's a good deal for CRM because this is what CRM does. I don't think they paid the greatest price for it, but I think they're never one to try to buy something at bargain basement prices. They tend to overpay. That tends to engender pretty good feelings with the company coming in. They feel pretty darn good. They're going to work pretty hard for CRM until they leave and go find something else to do. So, I think it works for them. It's a very typical deal of what they have done before.
All right, let's shift gears a little bit and talk about what has been kind of a hotbed issue as it relates to you and your trading strategy and your style, and that's how you handle drawdowns. Now, you must be able to weather them based on the fact that some of the stocks that you take, you'll have a drawdown, like say last week it was CLDR, ZUO I think might have been another one. And how do you handle those? Because I think sometimes some of the listeners may have a misinterpretation of how that plays out as far as your overall strategy.
Yeah, well, I think everything's got to be taken in the context of kind of what's happened previously, right? So I think, a CLDR drawdown would be much more difficult to handle if I hadn't already been long 10, 12, 15, 20 names, with really good returns, right? So in other words, I mean, here's just, if you just sort of back up, I mean, I think that, there's a lot of things we could say about this. But again, I've talked a lot about Warren Buffett. I mean, Warren Buffett doesn't use, position by position stops. I mean, he owns Teva. I mean, I don't know how far Teva's gone down. But one position is sort of not going to make or break his portfolio. So looking at holistically, I've never had one position break my portfolio. So I purposely set things up that way, and we've talked about that many times, right? The other thing, I mean, if you're a trader, especially in highly volatile areas, tech, biotech, energy, let's just stop at those three sectors. You're probably somebody who's used to, or you should be used to, pretty high levels of volatility. And it's not just like when things are good, it's not uncommon at all to have 50 to 100% to as much as multi-100% returns, meaning, multi-baggers. So if you're out there and you're attaining multi-baggers on other companies, and you've attained multiple multi-baggers, there's pretty much no way to do that and not be able to withstand drawdowns. 30. And I even said, look, and hey, this isn't a blanket statement like washing me of being wrong. As I said in the post, any price above the current price on CLDR that I bought is wrong. I mean, it's, at a point in time, right here, right now, any price above 495 is wrong. So I can't be any more clear than that. But this isn't the first position that I've ever quote unquote gotten wrong, and it won't be the last. It won't be the last. But I mean, if you just kind of go back, I mean, I think it's worth mentioning. I've removed 13, and by the way, this is since I've kind of been tracking this. I think I've removed more, because I think Apple was one, a focus list stock at one time. There were a couple others, but the ones that I have documented, I removed 13 stocks due to, again, what I call excessive price appreciation. I mean, they've risen so much I can no longer keep them in my focus list. That's 13 names. Now, 7 or 8 of those names were multi-baggers. So there's kind of no way that I'm going to have, 13 stocks out of 20 removed due to excessive appreciation, 7 to 8 of which were anywhere from 2 to 4x returns. I mean, that builds up a lot of portfolio value. So frankly, I mean, not to be flippant, but withstanding a CLDR now and then is not just something that is relatively easy to withstand. I literally plan for it. I literally plan that I'm going to have at any given time. I don't want 5 huge losers, but at any given time I'm going to have 2 or 3. I mean, there's always going to be a few names that just are not working. Sometimes it's because of a fundamental miss. Sometimes it's because of nothing. Sometimes it's just because of market lunacy. Sometimes it's because of sentiment. Sometimes because of the combination of all three. But if you just kind of think back, I think you gotta say, look, in other words, you can't be all things. You can't be a trader with super tight stops with a 3% stop on everything, and trailing stops of 2 or 3%. It's going to be very hard to get multi-baggers. Likewise, okay, then you can't, if you're going to trade that way, you can't be hunting for value and holding stuff 5 years. And likewise, if you're going to do that, you can't be an expert on energy stocks, biotech stocks, tech stocks. In other words, I'm just saying you can't kind of be all things, right? You can't be, hey, I'm gonna only buy stocks above the 200-day when that seems to be in vogue. And then, oh, God, geez, the last thing, I'm going to switch, and now I'm only going to buy stocks that are 40% below the 200-day. Okay, now I'm going to switch. Now I'm going to be a value guy. Now I'm going to switch. Now I'm going to chase momentum. In other words, probably the thing you don't want to do is you don't want to change your style every time a trade doesn't work. By the way, that's a very common trade with losing traders. They start doing something. They think this is going to work for them. They have a setback or a loss, and then they completely undo everything they've done, and they start chasing the hot dot, right? So, but just to kind of, again, to level set, if you are going to try to make 100, 200, 300% gains on stocks. That's now in this market, some of those have happened relatively quickly, but generally that takes time. That takes multiple quarters. It takes patience. There's basically here's another popular thing. People that sell every position before every earnings report. Again, I don't do that. Some people do that. That's some people's strategy. So, if you sell a stock before every single time they report earnings, it's almost impossible to imagine that you're ever going to get a multi-bagger return on a stock. So, again, you kind of have to think about everything that's happened before. And I know the popular expression is, hey, you're only as good as your last trade. The actual truth is you're basically as good as the last cumulative 500 to 1,000 to 2,000 decisions you've made, because that's basically the value of your portfolio. How have you been compounding over time? So again, not to beat the dead horse, Poop, Nutanix, Splunk, Twilio, Mule, Palo Alto. I think Palo Alto's been in there twice. Workday, Micron, PayPal, Akamai, Cyber, Okta, all removed from my focus list. So in other words, if you're gonna throw me the hate mail, throw me the hate mail. I could deal with it, because I can withstand a drawdown. If you're mentally tough enough to withstand drawdowns and mentally tough enough to be a professional trader for a decade or so, you're certainly mentally tough enough to deal with criticism. But anybody that that wants to level that criticism and sort of ignore the fact that I've had, 8, 10, 12 multi-bagger type returns, you're kind of conveniently leaving facts out. So now, as far as dealing with drawdowns, as I kind of put in that post, at this point, everything, every day is a new day. Can't change anything about the past. Hey, if I could change the past, I'd rewrite my own history very conveniently, and I'd undo every Cloudera buy, right? However, so here's something: if I sell Cloudera now, is that undoing every Cloudera buy? No, I'm just turning a unrealized loss into a realized loss. So from this point, is Cloudera a buy, sell, or hold? And I've been very clear. For me, again, remember, we're not telling people what to do. We're telling people what we're doing. It's up to them to make their own decision. So for me, I and we can go into why I'm holding, but I'm holding, not really buying, not adding. I might, but I'd rather just kind of hold it right now. Am I happy about it? No, I'm not happy about it. At the same time, did I go work out that day that Cloudera was down? Sure. Did I eat normally? Yep. Did I sleep that night normally? Yep. So look, if a position or results in your portfolio are giving you undue stress, you're probably trading too big. You're probably having too much margin. You're probably too leveraged. You probably have position size that's incorrect. So everybody has to think about those things. Again, I'm not happy about Cloudera. I'm not. But it's not going to emotionally wreck my mindset. It's not going to change my process at all. It's not going to change how I select tech stocks. It's not going to change how I do fundamental analysis, because again, I've dealt with this before. By the way, I own Splunk. I don't know if people want to hear about this, but I own Splunk. This will take 2 seconds. I owned Splunk in 2015 and 16. Splunk literally dropped 50% in a day. Well, I think it was about 3 days, but most of it was in a day on, funny enough, Tableau software. Tableau software was a $133 stock, which in my service at the time I'd been panning, and it had gone to 80, and from 80 it went to 40 on a miss, on a guide down. Splunk dropped 50%. Splunk literally had no news of their own. I bought Splunk at 32. I also owned some Splunk before, but a day or two before it was 60. Was I happy? Was I happy Splunk was down 50% on no news of their own? Now that actually did make me mad, because that was truly crazy. At least Cloudera was down on news of their own, right? But again, I don't even think it's worth getting into whether it should be here or not. It's here. The stock price is here. So the bottom line is, it's a stock. Hey, at the time, it's buy, sell, or hold. I'm choosing to hold it. And it's not that I've got some, magical wish that if I hold it long enough, it's going to go back up. I'm holding it because it hits certain financial criteria and fundamental criteria that I've learned personally for myself. This works for me. That if I blow something like this out, I usually regret it later. Sometimes it works. Sometimes it works. But generally, I'm better holding it. My view is there will probably be a time, even if I choose to sell Cloudera at a loss, and I put this in the post, I think I'll probably be able to sell it at a higher price. I don't know exactly what that higher price is going to be, but here's what I don't want to do, and I've made this mistake. I haven't made this mistake very much. I have friends of mine that this seems like that's all they do. They sell a loser, they buy something hot. Hot name usually becomes a loser again. Sometimes it works, but there's a lot of people who perpetually sell losers, chase, sell loser, chase, sell loser, chase, sell loser, chase. That actually becomes a very dangerous compounding situation. So for me, it's like, well, could I sell it here and go buy something? Sure. But, I don't really want to sell it unless I feel like I know there's something that, it's just something that I really like a lot better. And I've just kind of, one of my personal disciplines is, stocks that are selling this cheap, I generally haven't done very well if I've sold them. So, with stocks selling, roughly 2.5 times net cash, I generally do better holding those names. When stocks are selling, I think it's like 1.7 times sales now. Again, that doesn't mean it can't go lower. But, this is my personal decision. So, and that's what we're sharing. We're sharing what we're personally doing. It's up to people to do that or not, or listen to it or not. But again, I could provide lots of examples, a lot more examples where, I was buying Yahoo at 12. I had calculated the value to be $40-45. I don't even remember why Yahoo was 12. It had gone to 12 from about 18. This is pre-Alibaba. Same thing. I had owned it higher before. But I felt pretty good about buying it at 12. Certainly holding it. Felt pretty good about buying Splunk at 12. I'm trying to think of things that I didn't really buy. By the way, another name was Hortonworks itself. Hortonworks was I don't want to call it a hot IPO, but I think the all-time high on Hortonworks was like 2021. Hortonworks went to 7, and that was kind of during that whole huge 2013 shock drop phase. They might have had some relatively minor bad news, but it sort of dropped the same time as Data and Splunk dropped. I don't think I added a lot to Hortonworks, but I ended up selling it closer to 20. So from 7, that was a pretty good move. So again, I have no idea what Cloudera is going to do. I think the risk of a massive decline from here is relatively low. I'm choosing to hold it. I'm not buying it. I'm not selling it. I'm choosing to hold it. So, I would say there's other things. If you want to talk about Pivotal, now Pivotal, I actually it's exactly the situation. I wanted to buy more Pivotal. I hadn't bought a lot. I had a small position in Pivotal. That to me, I would say the Pivotal drop this quarter on the results that they had is probably one of the most shocking drops I've seen. Cloudera, I'm not saying it's not a shocking drop, and I think it's way overdone, but this is the second quarter in a row they missed. They had a chance to clear the deck a quarter ago. Some people thought they did. They didn't. They ended up, obviously guiding another 10% lower. So the market's really going to punish something like that. Pivotal their last quarter wasn't great, but for them it was fine. It was kind of more like an inline report. But they're only guiding numbers down about 5%. Pivotal's, I'm not going to say that they're, I'm not going to say they're in the category of how I felt about Pivotal, like as I felt about Mule. But it's kind of close, honestly. I like the name a lot. I think it's a very durable business. It's the same team that basically created VMware. Dell owns 65% of shares. But I would say a 5. I honestly can't remember, other than Splunk dropping 50% on a competitor news, I can't remember a stock dropping 45% on a 5% guidance reduction. So that's so extreme that these are the things I like to take advantage of. Other guys, maybe they want to take advantage of hoping that Zoom is going to go up more, or hoping that Zoom is going to bounce after pulling back 7 or 8 or 10 points. I feel very comfortable adding to the pivotal I added to. In fact, I added about half of what I wanted to add to it. I have quite a bit of room to add more. It might trade poorly for another 3 or 4 months or something like that. It's going to be a show me stock to the next print. But again, I'm very comfortable holding the stock I think is worth quite a bit more and accumulating, a lot more of the position at a much better price. Again, that works for me. This is what I've been doing for a lot of years. And, I could share tons of things. I was buying Apple when everybody was selling it. I was buying Google when everybody is selling it. I'm still buying Baidu. Everybody wants to hate me on Baidu. It's like, look, I feel pretty good about Baidu. By the way, quick note on Baidu. It's up pretty nicely from prior trades. If you're a rinse repeat trader, there's quite a bit of points to work with there from 107. So you can peel some here. I'm personally not selling it. I'm sticking with it because I plan to add to it a little bit more. But I am in close to kind of getting into rinse repeat mode on that. But hey, buying stocks after large drops is not something that I think it's basically now out of convention. I think in the 60s, 70s, 80s, I think a lot of people thought buying stocks after large drops was quote unquote the right thing to do. Now it seems like in the world we're in, the right thing to do is cut everything off after a small loss, chase momentum, look for the biggest relative strength stuff. Momentum investing has become very popular. I don't see very many momentum-based hedge funds that ever show up as stellar, strong, superior hedge fund managers, though. Almost all the great hedge fund managers that have produced the best returns long-term are kind of more value-oriented. So, in fact, I don't know of a single money manager with a fund or with a hedge fund that kind of does the, hey, it's above the 200-day, above 50-day, I'm going to buy it. I don't know of any of those guys that have produced long-term excessive returns way above the indices. So I don't know of any of them that show up in sort of the who's who of managing billions of dollars. So, just take it for what it is. Do your own research, do your own homework. I'm of the camp, kind of the old school camp, that I like to buy stuff when other people are selling things. I like to buy stuff cheap. I don't like to buy stuff at all-time highs and hope it goes higher. It's just not my way. But if that's what you like to do, I guess why are you even reading my stuff? I'm not saying you shouldn't read my stuff, but I'm just saying if you're constantly looking for the most hot things to trade, I'm not going to trade those. That's just not any kind of the stuff. I'm more of a growth investor, but right now there's not very many growth, not many pure traditional growth. Again, I was buying Okta, I was buying Coop, I was buying Mule, I was buying Twilio. I was buying all those growth names when they were cheap, or when I viewed they were cheap relative to growth. There's not much traditional growth right now that most people would call growth that's cheap. I think Redfin's cheap. Again, I think Baidu's but the cheap stuff now is probably more in the value camp as opposed to the growth camp. But again, it's a buy, sell, or hold, whatever the position is. It's up to everybody to make their own decision. Again, right here, right now, the last thing I'm going to do is blow out CLDR at 2.5 times net cash and 1.5 or 1.6 times sales. It's just not going to do it. This could be the one time out of the 5 or 10% of the time that it's the right thing to do. But again, I play the odds, and the odds have worked very, very favorably for me. We could go on. I could talk about some things I think about doing to sort of help recover the particular loss. But I'll just leave it up to you where you want to go at this point.
Well, one of the things that I want to dive into is in a stock like Pivotal and Cloudera, when you see a big move like this, it's going to take some time for it to recover. And I want to know, what are some of the things that you're going to be looking for that the company has to do and show you that things are on the right track? And at which point do you say, okay, the company is not doing what I thought they should be doing, and therefore it is valued appropriately, and I'm going to cut my loss?
Yeah, so I think for the first statement, I would generally agree. However, again, we got to be careful about generalities. The generality is it's dead money for a quarter, maybe even 2 quarters, maybe longer. That's not always the way things work. I can't. I've lost count of how many times people have told me Twitter's dead money. Well, Twitter's dead money went 3-bagger for me. So, but I literally did. All I kept hearing from Twitter naysayers is dead money. And, most people thought it was actually going to keep declining. But the people who even kind of liked it said, yeah, I'm going to wait, it's dead money. Well, it wasn't dead money at 14. It wasn't dead money at 22. Even last December, a lot of people were saying it was dead money. Had a pretty good move. So I would be careful overly generalizing. Cloudera probably will take time. But sometimes things recover quick. Sometimes something happens, you get a catalyst. As far as Cloudera specifically, or really Pivotal and Cloudera, I think the next 2 quarters will be somewhat telling. You're probably not going to get home run quarters out of them, because you typically don't get a home run quarter coming off of a low. In fact, there's almost no upside for a company to come out and try to produce a super, super good quarter that's actually going to be hard to repeat. It's probably better to kind of build ahead of steam, coming off of a low. But I think you look at the quarterly results. The single most important thing for me when a stock gets really, really hammered is cash flow production and/or the ability to produce cash flow. And so Cloudera is still pretty young in its sort of its lineage, if you will. It's not a super old company. Again, Data is starting to produce a lot of cash flow now, or it's ramping up its cash flow. Even Data doesn't produce a ton of cash flow yet. It will produce a lot more in a few years. Again, though, what's Cloudera's ability to produce cash flow? My first choice would be, I'd rather see them kind of get on with their business, get their growth resuming, and then attack the market like they've been attacking it. If they have to go into a cost-saving cash flow production mode, that's sort of a different thing. But I think they basically I put that in that long note on Cloudera. To me, there's 2 outs for it. One is they just sort of resume to get back kind of more the growth rate they had before. Which, by the way, I don't think that's a huge stretch. I was talking to one of my friends who has been a pretty successful trader for a long time. He's like, yeah, they're done. He's like, oh, they're done. They're I don't really think a company that's got $550 million is done. So I'm not ready to write them off yet. Again, we've talked about FireEye. FireEye has been struggling for a while. I'm much more willing to write FireEye off than I am Cloudera. I guess where I come out on all this, we'll see. I don't know if Cloudera's business is really that. Put it this way: is the business 50% worse than it was 90 days ago? I know this might sound almost juvenile, but I think sometimes you have to kind of think in the most simplistic terms. In other words, if you don't need to make something incredibly complex, don't. My view of Cloudera's business is it's basically the same business it was 3 months ago. It's basically the same business it was 6 months ago. They're doing a deal. Software deals. By the way, if I've been wrong on anything, it was underestimating the smoothness of how they would execute the software deal. Honestly, I didn't think they would have as many issues they've had. By the way, that gets me to an important deal here. I actually think most of Cloudera's issues are mostly related to the merger. So where I think other people are trying to say, all of a sudden, kind of out of nowhere, saying, "Oh my God, look at this this competition." And Cloudera's they've had the same competitive mix that they've had pretty much from day one. They've been competing with public cloud, private cloud, Splunk, Tableau, you name it. They compete with everybody. So, and I would say they're in a better position to compete today than they were 4 years ago as a standalone company with only venture funding. So, again, we'll see what happens. I mean, I'm not, I don't have the same price target for Cloudera now. I mean, it's going to come down. I haven't exactly recalculated it. But I got to look at the numbers. I got to look at the new analyst estimates and things like that. But put it this way, I don't think my price target is going to come down 50% because the deterioration in the business hasn't decreased that much. So I mean, that's something I looked at. Again, when I was looking at Twitter years ago. Now, Twitter did actually go through a phase where they did have declining revenue growth. It was very minor decline, but Twitter was formerly a 35-40% growth entity that lost all that growth. That was a major issue. And that ended up working out very favorably for the company. Cloudera, I would say the odds of Cloudera going to zero or negative growth are actually much lower than Twitter. That's kind of how I put it. But I still want, to me, I think the easiest way to play it at this point. So again, how do you recover from something like this? One, well, hopefully you have other positions. So one, sometimes you just do nothing, and your other good positions help recover the loss. I mean, that's the easiest thing. The two, then you have two choices. If you keep it, you can trade around it, or you can trade it themselves. With Baidu specifically, I'm trading Baidu. I mean, I get a few more $7, $8, $9 trades. In fact, just on simple math, 9 times 5 is 45. If I create 45 points of trading value trading Baidu, I recover a large amount of the Baidu drawdown of that name. I think with Cloudera, there's no trading setup right now. It's probably going to vacillate. I mean, some people are good at trading 20-cent moves. That's not my game. I like to trade things that have movement. If Cloudera starts moving from, let's say, 490 to 680, that's a range I would love that range to trade. Even better, 5 to 7, something like that. So that would be a very, very good range to trade. If it's only going to bounce and move 15, 20, 30 cents, I'm probably going to ignore it until I think it's bottomed. I'm probably going to trade around it. I'm going to trade other things. I'm looking to create trading gains with other names. But it's really this simple. So let's just say you have a $10,000 loss on said drawdown, whatever that drawdown might be. Hey, there's a lot of ways to chop that loss down. The thing I would avoid doing, you can try to recover the whole 10,000 in one trade / investment. I call that trading on tilt, playing poker on tilt, whatever. Where people say, hey, they actually increase risk. They do a riskier trade and they try to make back the whole thing at once. I would say that's compounding an error with another error. I would rather try to say, look, okay, if I want to make 100% back on a certain percent of my portfolio, if I make 25% back 4 times, there's 100. If I make 33.3, there's 100. If I make 10%, 10, there's 100. There's a bunch of ways to chop it down, but so you can either trade the name or you can trade around it. At this point, I'm going to trade around. I think this is a great time to have this conversation, actually, because I'm going to trade Baidu itself, and I'm going to trade. I'm highly confident I'll be able to trade out of my Baidu loss. I mean, still, a lot of people want to get back to even too. Here's the other thing: I have no intention of getting back to even on Baidu. I have intention of making a lot of money on it. So I haven't changed my price target on Baidu. I don't really intend to. I don't think the business has really changed much. So I think the fundamental story of Baidu is pretty much the same as it was a couple years ago. The only difference is I was buying the stock at 165 and not 265. So it happened to go lower, but I think Baidu has a very good probability of challenging all-time highs, if not exceeding all-time highs. So to me, I'm not trying to recover money on Baidu. I'm ultimately trying to hold the company until I make a really good gain on it. Cloudera, I'll be honest. If I got 850 to 950, I'd probably be relatively happy. I might take the loss there. But we'll see. I mean, hey, if the stock is back at 850, I'm going to evaluate Cloudera at its price at that time and what's going on with the company. I think that's the biggest thing, by the way. As you've seen in this whole, this whole conversation, to me, look, there's three things that don't play any part in this. One is, hyperbolic emotion. If you're going to be a successful trader, you're going to make a lot of money. You're going to have to suffer with setbacks. You're going to have losses. You're going to have drawdowns. You have to be able to deal with that. You have to be able to think through that, and you have to be able to, again, as you've seen, I don't get super carried away and like giddy when my account's up a lot. My emotional state's pretty much the same when my account's up a lot versus when I have a few names down a lot. It doesn't really change. It doesn't change the process. But I think you just have to kind of formulate a plan. Everybody's plan might be different. Again, I'm sharing the plan that is going to work for me. By the way, I've done this a lot. I mean, again, Splunk was pretty easy to trade itself. I had Hortonworks years ago. That was a loser. I traded around it, traded other things. Twitter at one point for me was a loser. I pretty much traded Twitter a ton, traded Twitter itself. So I've kind of been around all this kind of stuff. Yahoo way back when, 2012, that was a pretty big loser at the time. I didn't really do much with it. I just kind of let it go. And hey, there are positions that ultimately get swapped out for other things. So we'll just have to see. But like I say, I think the biggest thing is, are you thinking clearly? Are you making decisions clearly? Are you making decisions based on a plan that works for you? Or are you just doing something because you're mad? So hey, what's the easiest way to deal with something you're mad? Get rid of it. Okay, get rid of it. Now what are you going to do? Okay, well, now you have a little bit, you can use that money and trade. Okay, well, if that's what somebody wants to do, that's great. But, again, I would say that, don't look to try to get the whole chunk back at once. What I tend to like to do is say, look, I'm going to trade a little smaller. Instead of going for 25, 30, 40%, maybe I'll go for 10, 15. I get a lot of 10, 15% winners. So, I look to stack those up. It's kind of, I mean, these are just sort of general lessons you can probably read in any decent, there's probably not very many good trading books, but there's a few of them. But again, you want to trade bigger as you're doing better and getting more confident. Maybe after a setback, maybe you trade a little small. I tend to trade. I don't ever like say, look, I'm hot, so now I'm going to trade really big. I kind of tend to trade about the same size all the time. Or just over time, it just kind of grows with the proportion of my portfolio. So I don't tend to like say, oh, I'm hot, I'm going to trade twice the size I used to. Oh, geez, I'm cold, I'm only going to trade 1/10 the size I used to. I pretty much keep most of my trades, and we've talked about that. I keep most of my trades same size. A lot of my positions are relative the same size. In fact, the only positions I really have that ever get big through appreciation. I never really buy my way into a huge overweight. In fact, I don't think I really ever do. My big overweight positions occur because of price appreciation. If anything, I trim. As things go up, I trim. But yeah, I mean, like I said, just to review, you can either get rid of it, you can hold it, you can trade that name, or you can trade around it. So, or some combination of those things.
All right. Well, I think that gives us a pretty good perspective at how to handle trades that go against you, drawdown and whatnot, and how you manage to trade around it. It sounds like. I guess with that said, we'll leave it off for today and pick up again next week. I'm sure we'll have some other names to talk about. Earnings season's getting a little lighter, so I'm guessing that you're going to be in earnings prep mode, no?
Hey, there's not much. We're kind of waiting for. I mean, it's still a weird market. I mean, the other thing I'd say is I am just. I would say this is a market for me that I'm choosing to have higher levels of cash. I've been pretty vocal about a number of corrections. I don't love seeing the only stocks going up a lot the same names, and I don't like this market probably makes me as nervous as I was last year. when the FANGs were the only stocks going up and at highs. I didn't really love, like, I wasn't wanting to commit a ton of money to new ideas when NVIDIA was $300. I just wasn't. In fact, I was looking at shorts as much as I'm looking at longs. That's kind of where I am now. It's like I'm looking at shorts, I'm looking at longs, I'm keeping higher than normal levels of cash. There are opportunities, there are things to trade, but bubble markets. I'm not calling this whole market a bubble. It's just there's a few areas that are they can be really brutal. We'll probably never spend much time talking about Beyond because it's not tech stock. But what that hit yesterday is down $50 today. So a markets that stocks are acting like this. By the way, I would say it's equally irrational, the drop in Pivotal. I'd say the drop in CLDR is equally as irrational as the rise in Beyond. So when these kind of moves have shown the ability to occur, the one thing I guess I'm personally doing is, do I want to have as much exposure at risk? I've chosen not to, and you know me. We've talked about this. I've been riding lighter and trading lighter and having operating with higher levels of cash since March, April, and that's still kind of my modus operandi. So, but there's good opportunities. Really, what we're waiting for now is resolution. We're waiting for resolution for trade. I'll close on this. The one thing the other factor I don't like, which again has me cautious, is it seems like we're getting a lot of hope built in for Fed cuts. I don't know. I literally have no idea if the Fed is for sure going to cut. There's the expectations, I think, for a September cut are something like 80 or 85%. You probably know that number better than me. So what if the Fed doesn't cut? To me, just not doing anything would probably be fine. But if the market's built in huge expectations for Fed cuts and they don't cut, then what happens later? If they cut, well, okay, I'll deal with that when it happens. I don't know if that's going to be incredibly bullish though. So I don't know. We'll see. But there's the one setup I like is there's more cheap stocks now. So the problem is there's more cheap stocks to buy. There's plenty of things that have been hit. The problem is it's hard to buy a lot of stuff when, a lot of cloud stocks just made new pretty crazy all-time highs just yesterday. So, I kind of know what's going to happen. If those stocks go down as they are today, they're going to pull a lot of other stuff down with them that have nothing to do with them. Just like when the FANGs declined last year, when they really, really finally broke, there wasn't too many places to hide if you were long. So you either had to have faith in what you owned and hold through it, or you had cash or you had shorts. But I kind of think we're generally in that same setup. So the question is, when does it unwind, and when do things rectify, and when do things start trade in a more reasonable manner? Hey, I don't know. Took a few quarters for that for the FANG trade to finally unwind last year. It's probably going to be the same for this cloud trade.
All right. Well, I do appreciate you giving us some color on what you're going to be looking for, giving us some color on how you're trading around some of the deeper drawdowns that you've had, like CLDR and whatnot. So again, we'll be back next week, and we'll touch base on some of these, see how things are shaping up, and I'm sure we're going to talk about some upcomers that you're going to be on the radar for the next coming earnings season. As always, Sean, thank you so much.
And I do have a couple Q&A responses. I was going to finish this program with you and then get to those, but I do have a couple I'm going to address. They're mainly, I feel they've kind of been addressed, but I'll just kind of point people to the right posts, basically.
All right, sounds good. We'll be on the lookout for that. Thanks a lot, Sean.
All right, take care. Bye.
Okay.